All right, so let's talk now about the Secure Act's impact on contributions that you'd make during the year to charitable organizations. The Secure Act didn't specifically make a change to the way you can contribute to a charitable organization such as a church, okay? What the Secure Act did was, because it changed the RMD age and pushed it out to 72, that also changed the dynamics of how what's known as a qualified charitable distribution interacts with a required minimum distribution. So I'll explain first what a qualified charitable distribution actually is, and why our clients take advantage of it throughout the year. So qualified charitable distribution is a way for an individual with an IRA to contribute to a charitable organization directly out of that IRA account. All right. And the benefit of doing so in the past was because, and still today, was because they could reduce the RMD amount that would hit their earned income on their tax return, thus lowering the actual taxes that they paid in the year. So now, with the new Secure Act going forward, qualified charitable distributions, QCDs, are still allowed to occur at age 70 and a half, okay? And you can contribute up to a maximum of $100,000 per year. That was the balance that you could contribute maximum up to, before the Secure Act was introduced as well. What's important to understand is that because the RMD age has now been pushed out to age 72, QCDs can still be taken at age 70 and a half. There was actually a lot of confusion within the financial planner community about the impact that the Secure Act would have on qualified charitable distributions, because they were normally aligned with that age 70 and a half marker, which just so happened to be when RMDs were required. All right. So QCDs, now going forward, you can still take them at age 70 and a half. You can still contribute up to $100,000 maximum per year. The only difference is that you're not going to be taking RMDs yet. So what's the benefit of doing so? Well, you can still reduce or make the distribution out of your IRA account. And, if you're making large qualified charitable distributions within a given year, you're going to be reducing that IRA balance, which thus reduces the RMD percentage-wise that you'll be taking later on. All right, so there's that. Now, once an individual reaches age 72, which is the new RMD age, then the way that the QCD used to interact with the RMD goes back into effect. The RMD amount that hits your tax return in the form of earned income is reduced, and you have a tax benefit realized because of that.